U.S. core CPI rises 0.4%. Is the Fed less likely to cut interest rates? The U.S. Bureau of Labor Statistics, BLS, has reported that the core consumer price index, CPI, which excludes food and energy, rose by 0.4% in January 2025, surpassing the government's target. This increase was driven by higher auto insurance costs, airline tickets, and prescription drug prices. According to BLS data, core CPI has remained stagnant at 0.4% in most March reports and even hit a peak of 0.5% in December 2023. Meanwhile, the overall CPI also rose in January, marking its highest increase since August 2023, with household expenses like food, energy, and housing costs contributing to the surge. This persistent inflation may reduce the likelihood of a Federal Reserve, the Fed, interest rate cut in 2025, as it signals that inflationary pressures remain strong early in the year. Historically, January has seen relatively high inflation due to companies raising product prices and operational costs at the start of the year as part of their pricing strategies. What does this mean for the Fed? Market expectations for a Fed rate cut have diminished following the latest CPI report. The Fed has been cautious about lowering rates too soon, fearing that inflation could stay elevated longer than expected. Federal Reserve Chair Jerome Powell has emphasized that the central bank will closely monitor inflation trends before making any decisions. Additionally, recent economic policies, including tariffs on imported steel and aluminum, could add further pressure to inflation, making an interest rate cut even less likely in the near term. Stay ahead of market trends. With inflation and monetary policy remaining uncertain, it's crucial to stay informed and prepare for potential economic shifts. Subscribe for the latest updates on inflation trends, Federal Reserve policies, and their impact on markets and investments.